Hello, everybody. Thanks for joining us today. We've got a great panelist, great presentation, and very excited to be presenting Neil Shankar from our partners at CI. And we'll be talking about all things economy, markets, currencies, tariffs. It's been a hotbed of topics and issues so far this year. So very much looking forward to delving into this with Neil and trying to make sense of this all and see where have we been, where are we going, and what does this all mean for us, for our portfolios, and for managing money moving forward. So just give everybody a minute or two to log in, settle in. Hopefully you've got a bite to eat or something, and you can lunch and learn as we get along here. But again, thank you today for taking part, and we're very excited to get started very soon. So Leah, if you can go, perfect. So let's just quick check here. Hello, James. Hello, Julie. Hi, Linda. Hi, Paula. And hello, Susie. So thanks for joining us. I know we've got a bunch more. So do a quick intro about our team, and then very soon I'll pass it over to Neil. And just in case if you have to jet out for whatever reason, as long as you signed up for this webinar, we will be sending out the recording after the fact. So if you have to jet out, don't worry, we'll be sending you the recording and you can jump in and listen to whatever you've missed after that. So just a note on that. We do want to make this interactive as possible. So if you do have questions, use the chat or the Q&A below, and we'll get to it after Neil's presentation. Neil's got about 20-25 minutes of content, and then we'll be looking at some Q&A. So please feel free. That's what we're here for, and that's what we want. We want to hear from you and have some interaction there. This is our team, in case you haven't known or seen us before. Kashfi is our new client associate. She has joined us after completing her co-op program, and we were so happy with her that we wanted to bring her on full time. So I'm sure you'll be meeting Kashfi in the near future, but very excited to bring her on board. Rest of the team is unchanged, but there are younger, pretty faces in case you forgot what we look like. And then without further ado, we're very excited to present Neil Shankar from CI Global Asset Management. Neil's got his Economist hat on today, and he's going to be using that to basically share his perspective on the year so far, on what's going on, the geopolitics side of things, economies, tariffs, currencies. I mean, there's a lot really to unpack in today's world economy. So really excited to have Neil share his thoughts and share some charts and some insights as to how he and his team think about this and for what it means for your portfolios. So without further ado, Neil, I'll pass it off to you. You can share your slides and we'll get rolling.
All right, great. Thank you so much, Erik. And thank you all for dialing in today. I'm just going to share my screen. And Erik, if you can let me know if that's coming up on your end now, that would be great. Just give me one moment.
So far, so good. And there we go.
Where are we? Okay.
There we are.
You see it in full screen, or is it? Okay, perfect. All right. Well, thank you for that kind introduction, and thanks again for everyone who's dialing in. I think kind of Erik tried to summarize all of the events that we've had to digest over the past few weeks. And, we like to start off with a quote before we get into some of the meat of the presentation. And, I think this quote really summarizes everything, Erik, that you kind of alluded to today. And that's that there are decades where nothing happens and there are weeks where decades happen. And certainly over the past few weeks, we've been facing news headlines on tariffs, on immigration, on government efficiency, the DOGE, government cost cutting. So a ton out of the new U.S. administration over the past 100 days or so. So what we attempt to do is there's been a lot of noise. We try to kind of decipher what the signals are here and try to path forward the path for the economy. So before we get into some of the charts, as Erik mentioned, we want to kind of touch on these three key macro themes that I suspect will come up in our conversation today over the course of the next hour. And the first theme here is that uncertainty remains elevated. So this is all due to U.S. policy implementation. And it's not just policy implementation as it relates to tariffs, but as I alluded to, there's government efficiency, government cost-cutting measures that have been implemented in the past roughly 100 days. There's Changes around immigration policy, that's going to have a big impact on the economic path forward for the US and the labor market specifically. And then really, we haven't yet scratched the surface as it relates to tax cuts that the US administration is speaking to. We haven't really gotten too much details on deregulation as of yet, but these are all policy levers that the Trump administration has access to, and this will continue to drive uncertainty over the next few months. The second key macro theme here that we'll be discussing is the fact that the US economy is slowing. This was a theme that we were speaking to even prior to the tariffs, heading into 2025. The US economy in 2023 and 2024 was growing at a 3% plus pace in several quarters that we've been through. And that's just an unsustainable pace of growth for the US economy. It's not something that you can expect over the longer run. The potential output growth estimate for the US is somewhere around 1.8 to 2%. So we were expecting this normalization towards that trend pace of growth. And now when you layer on some of the uncertainty as it relates to tariffs, as it relates to some of these potential policy changes, you can only paint the picture for slower economic growth in the US to an even more greater degree. And then the last kind of key theme that will come up in our discussions today is around Canada's economy and Canada's economic outlook. This is tied to the tariff outcome. Now, heading into, if we kind of use that same lens of, where were we in 2024, where are we heading into 2025? Prior to the tariffs, and even absent the tariffs, the Canadian economy was actually on solid footing. You had begun to see some of the impacts of lower monetary policy, lower rates feed through to the Canadian economy. We had seen housing sales pick up. We had seen consumption come in pretty strong in the last quarter of the year in 2024. Now, the headlines on tariffs, the uncertainty as it relates to tariffs has certainly derailed that for now, but we kind of try to take a more optimistic outlook as it relates to the medium term for the Canadian economy. So that's in a nutshell what we'll be discussing today. Now I'll go through some charts, some slides, and hopefully that will help illustrate this picture a lot better. Okay, so to address, really the 800-pound gorilla first is the tariffs, right? That's really what's taken up a lot of our time over the past few weeks, few months, really since Trump was inaugurated on January 20th. And what we have on this chart is essentially the US average tariff rate. And what is that? Well, if you have an importer in the US that's importing a good from elsewhere in the world, they have to pay a tariff now to a certain degree. Some importers face still a 0% tariff, but some importers are facing, 100% tariff. And on average, if you take a look at across all US imports, that average tariff rate would have risen to somewhere around 20 to 25% following the Liberation Day announcements on April 2nd. Now, that's what this red dotted line on this chart is showing. But, as we all know, we've been hit with tariffs that have then been rolled back, that have then been re-implemented or re-escalated. And that red line has moved all over the place. And with the news that we've received overnight on some of the reprieve on Chinese exports into the US, that red line currently sits at somewhere around 10 to 15%, depending on how you're estimating this, what data you're looking at, whether it's 2024 trade data or the most recent month of trade data, somewhere around 10 to 15%. When you look back at this chart, we had to take this chart all the way back to the late 1800s. On April 2nd, we would have been facing the largest shock or the largest increase in tariffs in over 100 years. Even after today's news, which has led to kind of a rally or a knee-jerk reaction in the S&P 500 in broader U.S. equities, you're still sitting at around 10 to 15%, as I mentioned. That's still about an 8-fold increase relative to where this was at the end of 2024. So this is still going to have a material impact on the economy. Certainly, relative to a month ago, this is a positive story overnight. But it's still going to have an impact on growth, on inflation, and we'll kind of walk through how this will play out in the months ahead. And initially when we were kind of going through some of the details on tariffs, if folks can recall on the call, early in February, we were, Canada was facing a 25% tariff across all of our exports. That was walked back or put on pause for 30 days. And then in March, we ultimately received some reprieve as it relates to USMCA compliant goods. This is all part of President Trump's escalate to de-escalate strategy. What we've seen is, he started with this maximalist approach, basically pushing out, what can I get away with? I'm going to try to get away with as much as possible, bring people to the negotiating table. Ultimately, we may not land where we start, but it'll be better than where we were prior to his presidency. And that's been the approach. And, I think reading some of these quotes on the right-hand side of this slide from his Art of the Deal book that was actually published in the late 1980s, this has been part of his thinking for several decades now. This is something that he's been kind of utilizing in business and now in trade negotiations for several decades. And really, I think it's a symbol of what's to come. It wouldn't surprise me if, yes, we've seen a walk back now in terms of the tariffs that were proposed on April 2nd, but we may see, tariffs being imposed once again on other countries. We may see tariffs being walked back on certain countries that, where tariff rates are elevated. So his actions are meant to be disruptive and destabilizing by design to ultimately achieve an outcome for the US that was better than when he first took office on January 20th. Okay, so I alluded to this, and this table is essentially just showing the 5 key policy levers that Trump and the US administration has access to. And the first one is tariffs. Second is immigration. Third is government efficiency. And as I kind of alluded to at the outset of the call, this has really been the focus of the administration in the first 100 days. It's the red box that we've circled on this table here: tariffs, immigration, government efficiency. And when you look at, our kind of broad brushstrokes implications for growth and inflation as a result of these policies, there's kind of no arguing that these policies that the administration have focused on will hit US economic growth and fuel inflationary pressures in the near term. Now, there's questions about, what the magnitude is going to look like depending on where these policies land, but there's no questions about the direction. So that's what we've attempted to kind of show on this slide. The other 2 policy levers that we've heard a little bit of details on, but really hardly scratched the surface on, is deregulation and lower taxes. Now, if we look at the far right column on this table, those are likely to become those are likely to come to the surface towards the end of 2025, maybe even not until 2026, but those are positives for the economy. So it's something to kind of keep in mind, right? In the initial outset, as Trump's team has called it, there's this transition period where the administration is focused on tariffs, immigration, government efficiency. Those are likely to hit economic growth in the near term. But over the medium term or over the long term, deregulation and lower taxes will begin to come into focus. And that's a key point to remember when we think about the path forward for the economy, when we think about, whether we're through all of the uncertainty. I think the past 100 days has shown us that, uncertainty is elevated, and I suspect that, we've got some clarity on the first 3 policies, but there's still a lot of uncertainty as to how things look 6 months from now, a year from now. So just something to keep in mind as we kind of go through the presentation today. And then this table here just shows, and we're kind of getting into the market response to tariffs here, right? What we're showing on this table is essentially major equity market corrections over the past roughly 25 years. And, we're not talking about equity market corrections of 5 or 10%. These are severe equity market corrections like the dot-com bubble, the GFC in 2007, 2008, 2009, and COVID, in 2020. And you've seen the equity market correct anywhere between 33% to upwards of 50% in the GFC. The instance that we just went through, the trade war, there's still question marks as to whether it's we've come to an end here. But what we can clearly see is we peaked in the equity market somewhere in the middle of February, and the trough was reached on April 8th. And that resulted in a roughly 19% correction in the equity market. But the reason we show this chart is because when we look out from that trough on April 8th, or in the COVID period, 1 year out, the equity market not only has rebounded relative to the decline that occurred during that shock, but it's typically made up more than what it's lost during that peak to trough decline. And even in this current period, if you think through what has happened, and this chart was updated last week, so we've seen the blue line actually move higher than where it is today, but the equity market has already bounced back entirely from the Liberation Day pullback. And the reason we show these charts is just to emphasize the importance of staying invested. There's always that psychological reaction when you're going through the volatility, and having lived through the global financial crisis in my career and COVID, there's always that natural reaction that, oh, let's try to get more defensive here, maybe move to cash a little bit. But what's typically the case is it's extremely challenging to time that bottom. And in the most recent instance over the past month, there's been kind of false starts where the equity market has rebounded and kind of moved a bit lower, but over time, as the prior kind of table shows, the equity market always kind of extracts growth from the US economy, and you typically see on a broader time horizon, whether you're thinking about a medium term or a longer term horizon, the equity market not only erase the losses that occur in one of these sharp periods where you see a sell-off, but you actually see further gains. So it's just a point we try to emphasize to clients when we're going through a period of volatility like the one we've just gone through. Okay, so getting into the economic impacts of tariffs. And, on this slide, what we have is the US core PCE price index. It's essentially the Federal Reserve's preferred inflation metric. There's, a whole buffet of inflation data out of the US and even in Canada and various different metrics that you can look at. But this is the Federal Reserve's preferred inflation metric. And in theory, what we're trying to show here is tariffs are supposed to be just a one-time price level increase. When you think about a pair of shoes that you're purchasing that's being manufactured, say, in China or Vietnam, that are now facing a 25% tariff, originally those shoes are $100. This year, they may increase to $125, but in 2026, they're not going to increase by another 25%. Tariffs are supposed to be a one-time price level increase, and that's effectively what this chart on the left is attempting to illustrate in the red line, the red dotted line. Those are projections for, if we do see a tariff increase, how inflation is supposed to respond. The gray dotted line is actually just showing, the path that we were on as it relates to inflation prior to the tariff shock. And that was showing how things were headed towards the Federal Reserve's 2% target. Now, there's big question marks around this because if you look back a couple of years in 2022, 2020, we've just been through a period where inflation was very elevated relative to that 2% inflation target. So questions around psychology, right? Questions around are consumers expecting higher inflation as we look out a year from now? And most of the survey data that we've received over the past couple of months suggests that inflation expectations for consumers, for businesses, has increased relative to where they were just a few short months ago. Now, there's question marks as to what happens going forward. Will firms be able to pass on those price increases? The answer is most likely yes to some degree, given the period that we're coming from. But again, there's a big question mark around the magnitude that we're likely to see. Estimates suggest a 1% to 1.5 percentage point increase in inflation on the back of some of the tariffs. But it will ultimately depend on where tariffs land, what they look like 3 months from now, how much firms have stockpiled on inventories. We know that that's a theme that has occurred in the past few months. So those are all outstanding questions that will only be answered as we get that inflation data over the next few months. And then as it relates to the economy, tariffs are no question a hit to economic growth. Similar to the inflation surveys that we've received, we've also have evidence that consumer sentiment has deteriorated. CEO confidence is deteriorating, and businesses that had capex intentions for 2025 are either scaling those back or pausing or hitting the pause button on that. And which is why you saw the probability of a US recession rise following the April 2nd Liberation Day announcements. Now, it's since fallen to roughly around 40%, but it remains elevated relative to where we were in 2024 or at the end of 2024 because we've layered on this uncertainty as it relates to tariffs and the potential for it to slow economic activity materially. Now, the R word is a scary word. People do get scared because, as you kind of recall from that table, the GFC, COVID, those were all recessionary periods where we saw sharp pullbacks in the equity market. But for central bankers, for economists, the S word or stagflation is the even scarier one. And while the odds of that are also relatively low, below 50%, they have risen relative to where we were earlier this year, or even when we look back to the end of 2024. So just a quick explainer on what this is and why it's such a challenge for central banks. Well, a stagflationary environment is where you see growth slow, the unemployment rate rise, or job losses begin to materialize, and ultimately inflation remains elevated or even starts to accelerate again. And in that environment, it's an extremely challenging environment for the central bank to act on because they have one primary tool at their disposal. And in each of those instances, the GFC, COVID, they were able to cut rates immediately to support the economy. But in an environment where inflation is picking up and the Fed or the Bank of Canada is worried about inflation expectations becoming unanchored, it becomes challenging for these central banks to cut rates because by cutting rates, that also stimulates the economy and risks inflation accelerating even more than it has to. So, we're not in this scenario now, but I suspect the risks of this scenario have risen, particularly given some of the walk back of the tariffs. It's minimizing the downside risks to growth on the back of that, but the inflationary issues are still very prevalent and still really persistent, particularly given we never really got back to 2% inflation following the post-pandemic reopening period. Okay. So we've kind of touched on, the market response to tariffs, some of the policy changes out of the U.S. administration, the economic impacts of tariffs. Now what we want to do is just speak more to the broader U.S. economy and the Canadian economy. We'll obviously weave in some of the policy changes and tariffs given they're impacting the outlook. But to kind of set the stage up for our discussion, this chart essentially shows real GDP per capita across several G7 economies. And the blue line on this chart, or the top line on this chart, is the line for the US. It's essentially output per person in the economy. And as you can see, since 2019, real GDP per capita in the US has risen by roughly 9%. That's a cumulative percentage change. When we take a look at the same analysis for Canada, or the red line on this chart, it's effectively 0% or flat. So there's no questions that US exceptionalism was a major theme in the post-pandemic period. Even if you look at some of the other economies on this chart, they don't come close to the performance that the US economy had in the 2019 to 2024 period. And it's part of the reason why we saw such strong outperformance in US equities, in the US equity market. And there's questions about whether this will be sustained. And for us, when we were looking into 2025, there were some folks that were continuing to call for US exceptionalism, outperformance of the US. And the one thing that stuck out to us is that, yes, economic growth has been solid. It's been above 3% in the second half of 2024. But when we think about the composition of the US economy, so much is driven by the US consumer. And the US consumer was already looking to shift into lower gear heading into 2025. Well, the reason that that's the case is because when you look at this chart, we show income growth, which is the gray line on the chart, and spending growth, which is the blue line on this chart. And what you can see here is clearly income growth has slowed materially over the course of 2024. It started the year at around 3.5% to 4%. And it ended the year closer to 1%. So income growth in the US has slowed pretty materially. Spending growth has held up, at least up until the end of 2024. If you ignore that tick up in the most recent month, which is likely caused by tariff front running, consumers essentially rushing out to buy iPhones or cars or things that they expect price increases. That's led to a tick up, but if you look kind of at the prior few months, you had started to see consumption growth slow. And this was something that we were highlighting in our internal investment discussions, that, the economy has been resilient. The economy was exceptional relative to other economies in 2023, 2024, but, we need to expect a slowing. We need to expect a normalization is what we were calling it. Now, we suspect that when you look back, you just simply can't continue to spend more than you make. You can do it for a period of time. You can have consumption grow at a faster rate than incomes, but over time, these lines need to converge with one another. If you look at the period prior to 2020 on this slide, either you have income growth above consumption growth, or sitting on top one another pretty closely. So this blue line on the chart essentially needed to catch down to the gray line, and this was something that we expected to occur in 2025. Now, we weren't talking about a recession, we weren't talking about a stagflationary environment. That's all as a result of the tariffs and the tariff-related uncertainty. But we were certainly talking about an economy that was normalizing towards its longer run potential output growth, which was somewhere around the neighborhood of 2%. Now, when you layer on the discussion of tariffs, the uncertainty, what that's doing, as we kind of have already spoken to, but what we try to show in this chart is soft data or survey data has deteriorated materially, right? So the four bars on the left-hand side of this chart are essentially showing that, right? You have the consumer confidence index falling materially over the past 3 months. You have purchasing managers, either in services or manufacturing industries, suggesting that growth is weakening materially. And then you also have CEOs that are no longer as confident about the outlook as they were just 3 months ago. Now, that's certainly shown up in the survey data, or what we like to call the soft data, but the hard economic data, when you look at employment, like we got last week or the week before for the US, that still remains relatively healthy and robust. Real consumption, that also, you haven't really seen any signs of weakness as of yet, at least as it relates to the tariff shock. Industrial production is holding up. And in fact, when you look at all of these indicators, they may have even been benefited till now by some front running of inventories, some front running of consumption. But we suspect that that data is likely to soften in the current quarter, given how pessimistic consumers and firms have turned on the economy. Now, the most recent reprieve that we received overnight as it relates to US-China trade tensions may not lead to as big of a deterioration in the hard economic data as we would have expected a week ago. But certainly, we expect some softening to occur in the current quarter that we're in. As we approach the third quarter, a lot will depend on where the tariffs land and the outlook for some of the other potential policy levers that Trump has access to, whether it's deregulation and taxes or immigration. Okay, so moving into the outlook for Canada. This is, again, another important slide just to level set where we were heading into 2025, given all of the noise that we've had over the past quarter. And when you look at the area that we've circled on this slide, you can clearly see from 2024, which is the blue bar on this chart, the IMF was expecting growth to pick up materially for Canada. So absent tariffs, Canada's growth outlook was quite strong coming into 2025. You had growth accelerating from a roughly 1.4, 1.5% pace of growth in 2024 to somewhere closer to 2%. And again, this was as a result of all of the monetary policy easing that the Bank of Canada had conducted over the course of 2024. You had close to 200 basis points of cuts, or now we have more than 200 basis points of cuts from the Bank of Canada. That overnight rate has dropped from 5% to 2.75%. And that was beginning to permeate through the broader economy. That easier policy was showing up in home sales, it was showing up in consumers. And heading into 2025, we actually had a pretty favorable outlook for the Canadian economy. Now, the IMF just released their updated forecast at their April meeting last month, and clearly the dotted red line shows that the economic outlook for Canada is not as great as it was at the beginning of this year, given the tariff-related uncertainty. But it's still pretty much in line with where we were for 2024. So what they're suggesting is that growth is going to be weak for the second quarter that we're in right now, maybe the third quarter. But once we get past some of the noise of tariffs and trade tensions, and we kind of strike a trade deal with the US, economic growth is likely to pick up again towards the end of 2025. And even when we think about 2026, the outlook is even more favorable. And we'll kind of get into the details around that in the next few slides. But just to kind of level set, this is top line, our expectations and the IMF's expectations for growth. Now, when we think about the tariffs, Canada has been spared the worst case outcome. And there's a lot to unpack on this slide. And there's been a lot of developments over the past few months. But if we think back to late January when Trump was inaugurated, early February, when we were supposed to be facing 25% tariffs across all our exports, that would have been a pretty significant shock to the Canadian economy. Now, the US administration paused that 30-day, they provided a 30-day pause on February 1st. And then in early March, they essentially allowed all USMCA compliant goods to continue to be sent to the US with no tariffs. When you look at the detailed trade data on Canada-US trade relations, roughly 40% of Canadian exports that head to the US already comply with USMCA rules of origin. They've already filled out the paperwork as it relates to that. So they get that immediate kind of relief as it relates to 0% tariffs on USMCA compliant goods. But when we look again at the US Census Bureau's detailed trade data, we come to the conclusion that close to 90%, or roughly around more than 90% actually, of Canadian exports can go to the US under the USMCA provision. It's just a matter of firms that are exporters filling out the paperwork to essentially get that provision and have their goods shipped out to the US under that favorable trade agreement. Now, it's going to take some time. In the most recent trade data we had for March that was released last week, we saw that number moved from 40% to 50%. So now 50% of exports that were sent to the US in March went under the USMCA provision. But over time, that number should get closer to 90%. Now, this doesn't take into account the steel and aluminum tariffs or the autos tariffs, but ultimately 85 to 90% of our exports to the US should continue to go to the US under this 0% tariff. And ultimately what that means for Canada is, yes, the tariff rate has increased, or that average tariff rate has increased, but it's much less than feared just a few months ago when we were facing 25% tariffs across all our exports. Now, that's definitely a positive, but uncertainty is already weighing on activity, right? The Bank of Canada published a survey a couple months ago that showed this. They showed that 50% of respondents, firms that responded to their survey, had already been decreasing capital expenditure plans in response to tariff and trade tensions and the uncertainty as it relates to that. Similarly, 40% of those respondents had reduced employment or were thinking about decreasing employment just on the back of these trade tensions. So it's certainly the uncertainty from tariffs is more what's having an impact on the Canadian economy than the tariffs themselves. And when we think about households, as I kind of have mentioned a few times, existing home sales on the chart on the right were increasing heading into 2025. We were certainly finally seeing the positive impacts of monetary policy easing towards the end of 2024. But once we're facing this tariff shock or this tariff uncertainty, households have been basically sidelined. They want to wait for more clarity before they make what's often the biggest purchase in their life, so their home. So what we've seen in more recent data is housing sales drop dramatically in the months of December, January, February, and March. So just the uncertainty itself is weighing on activity. We suspect it's going to be a pretty significant weight on the second quarter growth that we'll get more information on towards the end of July, end of August. But the path forward for the Canadian economy ultimately depends on what happens with tariffs. Where do they land? What ultimately gets captured within tariffs? Are we going to continue to see the USMCA compliant goods face 0% tariffs, or is there going to be some new USMCA trade deal where you have tariffs on some goods and not other goods? So there's a lot of uncertainty as it relates to the outlook for the Canadian economy, but as I kind of stated at the outset, a lot of it will be driven by the tariff outcome. And this kind of I'll speak really quickly to this slide, but essentially what this slide is showing is Canadian real GDP growth declines during recessionary periods. So the Bank of Canada published estimates on what the effect of a tariff shock may have on the economy. They produced a range of scenarios, and we could have seen a pretty severe recession had we been facing the 25% tariff across all our goods exports. Now that we've been spared this for now, the likely decline is going to be significantly less. As I mentioned, expect kind of weakness in the second quarter, softness in the third quarter, but hopefully some reprieve on the trade front. Hopefully a trade deal, or at least a path to a trade deal, is struck, and then some rebound in the fourth quarter and beyond. And the other thing that will help kind of offset the tariff-related uncertainty is the fact the Bank of Canada has already eased monetary policy so aggressively. When you look at this chart, across all other G7 central banks, the Bank of Canada has led the way. We've seen over 200 basis points of cuts from the Bank of Canada. And as I mentioned, heading into 2025, that had begun to permeate through the broader economy. And we expect once this uncertainty is reduced, for those dynamics to come to the fore again. The other reason we're optimistic, and I'm sure most folks were watching the meeting with Prime Minister Carney and President Trump in the Oval Office last week, certainly to me, it felt as though the posturing around US-Canada trade relationships are on a better track than they were just a few months ago when we were being called the 51st state, or when Trump was kind of threatening 25% tariffs across all our exports. So a possible resolution to the trade tensions could be on the horizon, and that's another net positive as it relates to the path forward or the outlook for the Canadian economy. The other thing we'll highlight is the Liberal government's election platform. Towards the back of that election platform, they essentially kind of produced somewhat of a mini budget. The actual budget will be tabled likely sometime next month, but in that mini budget that they produced, we saw $130 billion of net new spending. When you look through the details of that spending, a lot of it is being used to build a more resilient domestic economy. Close to $30 billion is being allocated towards infrastructure-related spending. We have a huge increase in defense spending. That's going to support economic growth in the near term. So if this budget does get passed next month, that's certainly another tailwind for the Canadian economy as we think about the path forward or the outlook over the medium term. And the reason that that's the case is, particularly as it relates to infrastructure investment, is the hope of the new Liberal government is that this will spur on further private sector investment. The chart on the left is essentially showing how Canadian business investment has been we've had a pretty poor performance, especially when you compare and contrast it to the US. Firms have just simply not invested as much as they have in the US, given the red tape, some of the regulation, and this new Liberal government, their focus on infrastructure spending, their focus on reducing red tape around intra-provincial trade barriers by July 1st, all of that is a positive for attracting business investment in Canada. And while it may take some time for that materialize, the medium-term outlook for Canada has improved on the back of this development. And that should also help our productivity challenge. Productivity, which is the chart on the right, has been challenged relative to the US, and that's been driven largely by the lack of business investment in Canada. Now, if we see a shift in that dynamic, you can certainly make the case for a productivity improvement and an improvement in longer run potential output growth for Canada. Now, I think some questions had come in on, what does this all look like for the path forward for the Canadian economy now that we have a bit more certainty on the federal election? We have a little bit of a reprieve on the trade front. And, honestly, we hadn't looked at this data prior to this year, I would say, but this is the Economic Policy Uncertainty Index. And you can see it spiked in February and March when trade tensions were elevated, when there was talks of 25% tariffs across all our Canadian exports. And while it still remains elevated, relative to the decade leading into 2025, we have begun to see kind of early signs of an easing in this measure. So it's a positive sign. I think as we kind of move over the next few months, we'll likely see this blue line move lower. But it still remains elevated to its long run, but at the margin is kind of moving directionally in a more positive way. And then lastly, before I get into my closing remarks, just to touch on the Canadian dollar. Canadian dollar has been through a volatile period over the past few months. We've seen it kind of pull back below 70 cents when trade tensions were elevated in early February. In recent weeks, the Canadian dollar has benefited from a broad US dollar sell-off. What I like to show is the chart on the left. This has been across the board, across most major currencies. And even though we've seen a lot of the volatility, a lot of the weakness in the Canadian dollar, that's kind of taken form in many headlines. When we take a look at the performance relative to just after the US elections on November 6th, the Canadian dollar is actually slightly up. I mean, I think today, after the US dollar strength that we've seen since some of the tariff announcements overnight, we're roughly flat. But it's an important point to make, given at times it's felt like the Canadian dollar has depreciated pretty sharply, and there's no questions around it. It had, but in recent weeks, we've seen the Canadian dollar benefit from this weaker US dollar. That's been the case across most currencies. And then the last chart I want to show on the right here, when we think about the path forward to the Canadian dollar, for the Canadian dollar, what you can see is we're kind of currently in and around 72 cents against the US dollar. When we take a look at the long run average, so this chart goes back to 1980. The long run average of the Canadian dollar is somewhere around 83 cents, which implies a 15% appreciation for the Canadian dollar. This isn't something we're suggesting will happen overnight. This is our long run projection for the Canadian dollar. We expect it to appreciate slowly. There are going to be bumps along the road, but over time, over the medium to long term, we expect a stronger Canadian dollar and a reversion back to its mean. Okay, so before I kind of hand it back to Erik, just some 3 key takeaways I want to leave folks with. First is uncertainty remains elevated. As I kind of have discussed now at length, there's not just the tariffs that are at play here, but there's uncertainty around immigration, DOGE or government efficiency, deregulation and what that looks like, and what the eventual tax cuts out of the US administration look like. So all of that it's going to become more clear over the next few months, but in the interim, that uncertainty is likely to continue to remain elevated. The second key takeaway here is that US exceptionalism is fading. That was evident heading into 2025, as we highlighted, given the US consumer and income growth was slowing. And we suspect that, layering on some of the tariff impacts, layering on the uncertainty as it relates to the tariffs, only increases the case for US exceptionalism and US slower growth in the US. And then lastly, tariffs aside, Canada's medium-term outlook has promise. So we've talked about how we've recently struck kind of a bit of a better posturing around US and Canada trade relations. The posturing has changed a little bit, I should say, relative to a few months ago. The new Liberal government also has proposed policies that are seen as pro-growth. We'll see, what materializes, but certainly, I think at the outset, kind of looking at things early days, suggests that that should help to improve business investment, help to improve longer run productivity, and ultimately kind of help to improve the prospects for Canadian economic growth in the medium to long run. So I'll leave things there. Thank you again for having me on today, and thank you all for dialing in.
Well done. Thank you, Neil.
Hang on.
Thank you, Neil. That was
Thank you, Neil.
great.
Of course.
So we do have some questions that came in, and you addressed some of them, and that was really great. I think Erik, Jeff, and I will probably have a few questions to share from the audience, and then also some of our own. So, can you just give us a little bit of your thinking on the outlook for technology and AI stocks? Because obviously that was a big contributor to the run up in the past few years, and now we're thinking, well, what's going to happen going forward? Does that continue? Is AI going away as a trade? What are your thoughts there?
Yeah, sure. I mean, it's I think as you kind of alluded to at the outset, or maybe Eric, maybe it was Eric. It's my lane is primarily economics and kind of the path forward for the macro economy. But when I think about the AI dominance for the U.S. and how that's been such a dominant theme for U.S. economic growth, I suspect that that will continue to some extent, particularly given the U.S. administration is so focused on ensuring that they're a leader in AI. They want to kind of secure the chips around AI through some of the trade deals that they've kind of that have come to the surface, come to the fore. I suspect that that will continue to be the case, and given that it will continue to remain important, I think that it'll be a dominant theme in the market, at least from a wearing my macro hat and kind of sitting at it from this side of the table and looking at it. I suspect that that will continue to be a dominant theme in the market as we kind of look out the next 5 to 10 years. It may not be there may not be that exuberance that we saw
Yeah.
over the past couple of years, but certainly I think it's a theme that will remain apparent as we kind of think through the market for the next year or two. And we've seen that even today in terms of the sector composition and some of the rebound following some of the tariff reprieve.
Awesome. And I know that Jeff has some questions that he'd probably like to ask, so I'm going to throw it to Jeff now.
Sure,
Yeah,
hi,
absolutely.
guys. First off, I want to shout out to Janet and Paula and Susie for being on this call, which these are clients that I've been with for years, and it's good to see them interested. Really good summary, Neil. While you were talking, I grokked our productivity position relative to the U.S. to understand that a little bit better. And in fact, yeah, for sure, our companies haven't invested in the technology and the infrastructure, their productive capacity to keep up with certainly with the U.S., which is interesting, and hopefully that'll be encouraged going forward. It's today we have evidence that Trump, with his art of the deal sophistication, blinked pretty hard when he realized that the shelves will be empty at Walmart and Costco and everywhere else with all this merchandise sitting on ships, and China was not going to concede. So he won't admit to it, but that's in fact what happened. I'm not sure we're going to be so lucky in our negotiations, but I'm hoping that this is the kick in the butt that Canada needed to start, pulling itself together and turning itself into a self-sufficient country instead of relying on its trade with the U.S. So that's my hope, anyways. And I mentioned that a year ago. So what do you think, Neil?
Yeah, I mean, I 100% agree. I mean, it's unfortunate it took Trump to essentially light the fire under our feet, but we've seen policymakers, whether it's the Bank of Canada or the federal government, talk about this for the past several years. I mean, I think increasingly, but there's been a lack of action for sure.
Yeah.
And if you look through the Liberal platform that was published just a week prior to the election in April, a lot of the focus is on improving that productivity, and it's going to take some time. It's not something that will happen overnight, right? You have to have businesses invest in Canada, and then that to slowly start to percolate towards our productivity problem that we have, which is essentially output per hour worked. So if you can get workers in our economy producing more output per hour they work, that solves the problem. And I think business investment is certainly a first step towards that. The other thing I'll mention is on immigration, right? Immigration is also a reason why we've had real GDP per capita declines in Canada or productivity falter. With the Liberal government's target to move non-permanent residents from 7.3% towards 5% of our population, that itself is going to also help with that productivity issue as you have more workers in the You have fewer students in our population. You have more productive workers that remain in our Canadian economy that are ultimately going to boost the overall productivity for our country.
Yeah, no, for sure. I mean, that immigration of low-skilled workers was a factor, but it's always a competing interest. If you can bring in strawberries and lettuce from the U.S. at $2 a crate, do you want to invest in the productive capacity to produce it here in a greenhouse or whatever? And now with the tariffs shocking the system, the answer is yes, we do, because we think we can. We can as a country absorb that product and not have to rely so much on importation. So I'm hoping.
Yeah, we're all hopeful.
That's
We're all
just
hopeful, and I mean,
Yeah.
we're hopeful that it may not be solved overnight, but certainly over the medium term, I think the prospects for the Canadian economic outlook are positive.
Good.
Or do we just start, or Jeff, do we just start buying stuff from other countries instead of the US? So
Well,
yeah, like strawberries are more expensive from South America, but when I go to the grocery store and they've got them for $4.99 a quart from the US and $5.99 from South America, I'm buying the South American one.
yeah,
Right?
as are
So
most
yeah, so
Canadians.
my cost has gone up, right?
Yeah,
But
yeah.
I don't think we're going to get them cheaper if we do them here in Canada. So that's the other thing too. So the U.S. is really shooting themselves in the foot to a big extent, and you
I'm
see that
hoping.
in
Yeah. And
travel
now the other
and
thing I just
tourism, right?
thought I could mention, because I did have a nice conversation with someone in manufacturing in the glass sector, in fact, and he said, broadly speaking, the export of Canadian product to the U.S. For their product mix is generally around 20%. Even in the steel industry, I think 20% of their capacity was going to the U.S. And they felt that if they could break down the trade barriers interprovincially, 15% of that loss can be picked up within Canada, which leaves them on a
Yeah.
5% net, which then they want to look to Europe and Asia for that. So I think a 5% we can survive with if we can trade better amongst ourselves, which would be the ideal dream, right? And among other things, but anyway.
Yeah, having interprovincial trade barriers is about the most ridiculous thing I've ever heard of, and I can't,
Agreed.
frustrating for years, and I can't believe it's still there. So solving that will
Yeah. Well, no
immensely
comment to
help
our
Canadians.
Western foes. Yeah, no, I know.
Yeah.
Anyways. Okay, well, I'm satisfied. I feel better. I'm gonna have a good lunch now.
There you go. Erik, do you have we got 9 minutes left. Do you have any questions, Erik? One more and then we'll call it a day.
Sure. I had one more, Neil, maybe with the incoming change on the Canadian side of things. How does maybe you or your team plan for that, or any anticipation for kind of given the new party that's coming in? What does that look like on the economic scale, and anything to look out for there? Your thoughts on that?
Yeah, I mean, for us, when we were looking through the Liberal Party's platform that was published just a week before the election, but when we were looking through that, we certainly were optimistic. There were reasons for optimism in that platform. I think when we think back to the Liberal government of 2015 to 2025, there are certainly key differences, right? And we've talked about interprovincial trade. Prime Minister Carney has talked about reducing all interprovincial trade barriers by July 1st. So that's a non-monetary goal that's in place now with a pretty short kind of time horizon or timeline for implementation. We're less than 2 months out from that date. So if we can kind of get the ball rolling as it relates to that, and then some of the new spending measures that they've proposed as it relates to infrastructure spending, as I've highlighted, if that has a potential to kind of spur on investment, that's going to be the big question, right? And I think, it may have taken Trump, as we've kind of discussed, may have taken Trump and these threats to ultimately kind of get the ball rolling, but we're optimistic on our team that now that the ball is rolling, that it should hopefully continue to roll and ultimately manifest in something that's that's better for our medium to long-term economic growth.
Well, that's great. No, I think that's great. Thank you, Neil and Lauren and Devendra and Jacob for putting this together. A huge thank you to Leah for all your hard work in putting together the webinars as always, making sure the invites go out on time and people are aware of it and are welcome to join. And then all the work that comes afterwards, preparing the recording and getting it up on our YouTube channel and Spotify and so forth. So thank you, Leah. And so I just want to thank everybody for joining. And if you have any other questions, just feel free to shoot us an email, and we'll bring them up to Neil, and we'll get you an answer. But we're always here to help. And I hope everybody enjoys the day. It's sunny today, but I don't know when you're watching this, so we'll see what happens.
Yeah. Okay. Excellent.
All right,
Take
great.
care, everybody.
Thank you for having me. And yeah, if any questions, please feel free to reach out.
Thanks, everybody. Have a great day.